Hello and welcome to the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Sean Brodrick, editor of Wealth Megatrends and contributing analyst to Weiss Ratings Daily. And Sean, it's always great getting you on the KE Report just to talk to you about what has your eye in the markets. And we don't always stick to commodities, but today we are going to stick to commodities because really across the board, everything is ramping higher. We've seen some big moves in gold and copper and oil, a lot of other base metals getting a nice bid. We've seen cocoa going to the moon. We've seen some of the other grains doing well. So the commodity sector is definitely getting an inflow of capital from investors. But let's kick it off with gold, the yellow metal. How are you looking at things now as it continues to scorch higher and higher, Sean?
Yeah, well, we are going to talk about three things, as you said, gold, oil, and copper. And the funny thing is, there are three different drivers, all commodities, and I expect commodities to do well this year as a class, but they'll all be different as well. I mean, gold, for example, that's being snapped up, especially by central banks, but also institutions and individuals. They are buying bullion, which is really important. So, not the ETFs, but actually buying physical bullion for currency concerns in China, economic concerns elsewhere in the world, geopolitical concerns pretty much everywhere because people are really starting to worry about a shooting war in the Middle East and maybe over Taiwan as well, along with the wars we already have going on. So gold is rallying hard. We are approaching my first initial target, which is just over $2,400. I did take some big gold gains this past Friday. I'd rather be early than late. And so I still have some gold positions on. I just think when we get to the 2,400 area, then we're probably going to pause. So that doesn't mean the gold run is over. Like I said, there are all those forces in play. And watch the central banks. They are really buying a lot of gold. Now, we have seen some announcements. For example, Kazakhstan's central bank said it might start to sell gold. That hasn't really weighed on the market yet, and it shouldn't. But one thing we have to keep in mind is that as the price goes higher, there will be some sellers come into the market, whether it's central banks or whoever. Will have more sellers come into the market attracted by the higher price.
Yeah, Sean, it's pretty fascinating because as far as that $2,400 target that you've had, and that was a great call, by the way, a lot of other people have been looking at that area too, or 2,500 because of the mini cup and handle extension on the chart. But we got up to 2385 just last night, and we're
Yeah.
currently at 2365. So we're not very far away from that level. And the other thing I would note is that silver finally got it gear, and it's up above 28 at the time of this recording. And the gold and silver stocks have finally started moving. So when you look at the move that silver and the precious metals equities have made, I know you said you took some profits, but for people that are looking at this move from the sideline or maybe a little puzzled at how quickly things took off, do you think there's still time for it to run in the medium to longer term with some of these precious metals equities?
Medium to longer term, sure. I mean, it all depends on your time frame, doesn't it? So, as I said, I think we can run into overhead resistance fairly shortly. And so, if you're just a short-term trader, then I probably wouldn't be buying. That said, you can pick up because I might be wrong about that. It might just blow past 2,400, go to 2,500, go to 2,600, go to 3,000. We don't know. So you can take half a position now, something you want to own, and if it pulls back, you can add to it, and then you'll feel like Mr. Smarty Pants. So that's what you can do too.
Yeah, you don't have to buy it all in one chunk, and you can also buy in tranches just as a way to get positioned. And you can always take little nibbles here and there on the pullbacks. We should also mention that in addition to the yellow metal, the red metal, copper, has been doing good. Dr. Copper, the health of the U.S. economy. Now, you said that there's different drivers here on these commodities. Why do you think copper is doing so well? It not only did it break above four, but it's up kind of testing that high that it made last year, which was around 435. So just a few copper pennies away from that level.
Right. And it's good to remember coming into the year, all the experts said this was going to be a terrible year for copper because of what was going on with China's economy, which once again shows that Wall Street experts are often wrong. But copper is rallying due to rising demand for electric vehicles. I mean, they use a lot more copper than an internal combustion engine powered car, right? And also renewable energy. That's on the demand side. It's also being boosted along by supply constraints, in particular, the closure of the Cobre Panama copper mine. That's one of the world's largest sources of copper. It supplied 1.5% of the world's copper. And as your listeners know, I'm sure the prices for these things are made on the margin. So you just take off something like that from supply, and suddenly prices are really going to move higher. And then no one's really worried about China at this point. There's other driving forces in this market. And eventually China will sort things out. They'll come back with demand probably. And so that's going to boost copper yet again. So yeah, I think copper looks pretty good here.
Now, as regards to the copper stocks, are you positioning in any of the junior explorers or developers? Do you have any positions in the producers? Because if we look at something like COPX, which is the largest copper producers, it's been blasting out to new all-time highs on the chart. So the biggest companies are getting a bid, but maybe not so much the smallest companies yet.
Yeah, I'm an idiot. I took gains on the copper stock I was holding in March when we had that breakout. I said, "Oh, surely it will pull back now." Well, it did. It didn't pull back for long. So a gain's a gain. I'm not going to worry too much about that, and I will buy again if it pulls back. But I like producers here. The thing about copper mines is they take so long to develop and so much money. I mean, they have to be huge, otherwise you aren't going to make money. And so I tend to concentrate in the producers. That's just the way I go. It's worked for me. That way I don't have to worry about some copper exploration project sitting around for 10 years not doing anything.
Yeah, that's a solid point because these projects that for copper, they're so capital intensive. Some of them are billion or billions of dollars to get built, and sometimes they stay on the shelf for a long time. Just another question on the copper miners, just because we don't get into it as often, Sean. There are a couple new ETFs, like in addition to COPX, COPX, which is kind of like the GDX of the copper space, there is COPJ, which is a new Sprott Junior Copper ETF. There is ICOP, which is a new iShares copper fund. And then Sprott has another new one, COPP. So we've now got four copper ETFs. Does that signal to you that the bigger ETF players are starting to see a trend here that may last more than a quarter or two, but maybe a longer term trend?
Maybe COPP is a new one to me. I'm familiar with the others. And so I tend to use the COPX as what I want to look at because I pick out individual names out of it. Because as people buy the COPX, the larger positions in that will go up anyway, because there's more money flooding into those stocks. But now I have to research COPP. But yes, this does show the market broadening out. And I think commodities were down for so long. I mean, the metals anyway, they were down for so long that the next move higher has to be a big one. And for a long time, too. I mean, it is probably going to go a while. So it's smart for Sprott to spread out like this, get some more exposure, give people more ways to invest in this industry. Because, I mean, that's a smart thing because not everybody is the same investor. They want different investments. So this actually sounds pretty good.
Yeah, the same kind of criticism that Sprott took for getting into a lot of the uranium ETFs a couple of years ago looks pretty smart now in retrospect. So just curious to see the new influx of copper ETFs in the space. Well, let's shift over to another energy sector here, and that is oil and the oil stocks. It has been interesting to see oil was stuck in a range for a long time between the mid 60s and mid 70s. It's finally popped its head above 80, got up to the mid 80s. But what's really been stunning has been the oil producers, the biggest ones in the ETF XLE, have just blasted off to new all-time highs. So just like with gold, just like with copper, we're starting to see some of the larger producers really breaking out here. What do you think is driving the moves in oil and the oil stocks?
Well, it's a good old-fashioned supply-demand squeeze. I mean, OPEC plus, which is the usual suspects over at OPEC plus whatever international miscreants Russia brings along to put the plus on it. I mean, they have abided generally by the production cutbacks that they've had in place for quite a while. And even times when like Russia started to outproduce, Saudi Arabia called them on it and they pulled back their global exports of oil. So there has been a drop in global supply. At the same time, there's been rising global demand. You're seeing more and more agencies raise their expectations for global oil demand this year because whatever problems countries had, and it's beyond China. They were looking for a global recession. They didn't get one. And so global oil use is really moving up. And now we have Mexico saying that they're not going to export as much oil. They're going to keep more of it for themselves to try and keep oil prices lower there. That's self-defeating. They desperately need that oil money. But nonetheless, that's what they're going to do. And so that's taking a lot of Mexican exports off the market. And so I think this move in oil looks quite powerful. And I don't know if it'll ramp up super fast, but I think we'll see triple digit oil prices sometime this year. And again, it could pull back from there. I mean, nothing says we have to go back to 130, but we are going to see oil prices head higher. So what you want, and you and I have talked about this many times, you want oily producers, those stocks that get most of their production from oil. And if you're looking at natural gas producers, they have to have some kind of angle, like say they're exporting a lot of natural gas to Europe via LNG, something like that. That can work, because the LNG prices are over there. But here in the US, I would definitely look for more oily producers because those are the ones that will really make you a ton of money this summer. Should be a great summer for oil stocks.
Well, and just diving into the oily producers, there are some that are the larger players. There's the mid cap ones, and then we also have some of the smaller ones that have a little bit more potential for growth, but also more potential for risk. Are you liking the bigger producers with the fat dividends, or do you like some of those smaller producers that have that growth wedge?
I like them across the scale. I buy different ones for different reasons. And I think you can make a good case for some small companies because they're going to look very tempting to these larger oil companies that have all this cash and would like to expand their reserves. And the easiest way for them to do it is to pick up one of the smaller companies.
All right, well, we'll keep our tabs peeled on the oil producers. And then just one more commodity we're going to squeak in real quick, and that is uranium. We like to talk with you, Sean, about uranium and the uranium stocks. It's not been a stellar year for the uranium stocks after a couple of years that were just blowout years, but recently it seems like they did find their footing, the uranium equities, and so did the uranium price and started ratcheting higher. It's not been a strong move, but how are you playing things in the uranium space right here?
Yeah, well, I recently added a uranium stock and it's down now. And I already had some uranium stocks. I sold a whole bunch of mine back during the earlier peak, just because it seemed like a great time to take profits. And it turned out that was right. Now I've started to ease back in. I think what's weighing on those uranium stocks now is the thing that's weighing on the broad market, which is the fears about the inflation number we are going to get on Wednesday. And so Wall Street has started to convince itself that even though Fed Chair Powell promised three or said the Fed was happy with three rate cuts this year, they are convincing themselves there's only going to be two, or else maybe we won't have any rate cuts at all because the economy is too hot, inflation is too low, and we are seeing higher prices for oil and like things like that. And, I mean, Wall Street gets caught up in these fevers. Like, if you remember at the beginning of the year, they were certain there were going to be 7 interest rate cuts this year. And that seemed absurd to me. I was in the higher for longer camp then. Now I seem like a real dove because I expect the Fed to start cutting rates in June, whereas many on Wall Street don't believe that. And so we'll have to see what happens with the numbers that come out Wednesday. And so, in case anyone's wondering, we'll be looking at the core CPI print. The consensus is calling for that to increase 3.7% year over year, which would be down from 3.8% in February. If you get something harder than 3.7%, then the hawks and the market bears will feel that they were right. And in the short term, they would be right. Longer term, though, the trend in inflation is down. And oil prices can go higher. That's true. But there's a lot of efficiencies being put into the economy right now, part of which is artificial intelligence, part of which is robotics, part of which is a lot of things. So I wouldn't worry too much about that. And we have a lot cheaper energy here in the US than in say, places like Europe and stuff like that. So We'll have to see what the inflation print is tomorrow. That can dictate a lot. But if it actually comes in as expected or even cooler, which could happen despite rising oil prices, if that happens, then we're probably going to see a weight lifted off the market, and that includes uranium. I still expect uranium to have a great year. I mean, it already had a big run before. Then, of course, nothing travels in a straight line. Of course, you're going to see a pullback. But I am making a list of names that I want to buy because I can't wait. I think it's going to be a fantastic year for uranium. I'm still incredibly bullish on it. And so I'm looking forward to that.
Okay, well, that's a good positive outlook. A lot of people are wondering if the uranium move was over, but it sounds like you're still encouraged. It has some legs to run, and we'll definitely keep our eyes peeled for how the inflation reading comes in on Wednesday, but also what the talking Fed heads have to say about potential rate cuts. Just as we wrap up here, Sean, we've talked a lot in the past about some of the different publications you put out. We mostly talk about Wealth Megatrends. We have talked about Super Cycle Investor as it relates to AI, but you also have a third publication called Resource Trader, and it may be more germane for some folks listening here because that's where you talk about some of the resource stocks. So maybe just explain to people what you cover in your Resource Trader publication.
Yeah, well, Resource Traders where we took all the big gains on Friday. I mean, because plenty of gold stocks, gold options. And so, yeah, basically it covers the things that we've talked about here today. Copper, gold, oil, uranium, stuff like that. And also stocks that are investing in the reindustrialization of America, which I think is a big trend, which, it was hot for a while. Then people's attention went elsewhere, but the money's just starting to get spent in there. There is going to be a lot more investing in new factories and stuff like that. So there's a lot of potential for that publication this year. And so everyone was really hot on things like AI, which I still am. I think we're in a new tech supercycle that's being led by artificial intelligence. But you can't ignore resources. You need the actual physical things to make all these fancy new tech things work. And there is plenty of demand in the actual hard physical asset side of the market right now. And so I think that has extraordinary potential.
Well, Sean, we definitely appreciate you sharing your insights with us here at the KE Report. For those interested in getting a little more information on Sean's work, definitely click on the link below this. It takes you over to his Weiss Ratings page, but you'll see all three publications linked on that page. And Sean, as always, looking forward to our next conversation.
No, thanks very much.